Good afternoon, everyone, and welcome to our year-end tax planning webinar. It will all be about your equity grants, year-end tax planning, and your equity grants. Thank you for joining us. My name is Beata Dragovic, the founder of Freedom Trail Financial, a financial planning wealth management firm in Boston. We work with clients on a long-term basis and believe in a strong foundation of comprehensive financial planning that includes accumulation goals, retirement, education planning, investments, and tax planning. Also working with professionals in the biopharma and tech fields have allowed us to consult extensively on equity compensation strategies with our clients, and that includes also transition, which is strongly present in these sectors. So because of that, obviously that will be our major topic as it comes to for today. So today we will focus on the following. We will touch on basic facts about the latest tech developments. Not too many things changed in 2019 that can affect your stock compensation. We will review the most popular equity awards and their tax implications, and obviously we'll talk about year-end planning strategies and ideas, what you can think about. I will probably repeat this a few times in this presentation, but I definitely have to talk about it right away up front, that as us as financial advisors make these decisions as very closely collaborating with tax accountants. This presentation is very technical. We will talk about taxes a lot, so I do like to point out that I highly recommend that you all work with a financial advisor, and as well, everything that we discussed, these are ideas, and everyone's situation is different, so you have to discuss all your ideas and any changes that you might make before year end or next year with a tax accountant. So 2019, as we see it, there were really no major changes in the tax code that will affect your stock compensation. It's really the Tax Cuts and Jobs Act of 2017 that made the changes, and some of the major ones were the income tax rates got lowered, and also the alternative minimum tax, the changes in the calculation of the alternative minimum tax that we will talk a lot about today is that will definitely affect and affects your stock compensation, especially incentive stock options. And I also want to point out that business tax changes are pretty much permanent from the Tax Cuts and Jobs Act, but changes affecting individuals at this point will expire at the end of 2025, so that you definitely need to know about that as well when you make your tax planning. Obviously, legislation can change. So again, what were those major changes? So the changes in the rates of individual income tax, they got lowered, and they range between 10% and 37%. The calculation of the alternative minimum tax, that's very important. Both, and we'll talk about this more on the upcoming slides, why the AMT, alternative minimum tax income exemption amount, got increased significantly, as well as where this exemption amount starts to phase out. For couples, it's over $1 million in 2019, and for single filers, it's over $500,000. So we'll touch base on that a lot and how it will affect you. And there were really no change in the capital gain tax rate. So I like to point out that the reduction in ordinary income tax rates, which actually applies to short-term capital gains, lowers pretty much the difference between your short-term and long-term capital gains rates due to this fact that the capital gains rate didn't too much change. So we will talk about the most common equity compensation plans that we see in both in the biopharma and the tech fields lately, and those are stock option plans, non-qualified and incentive stock options, as well as restricted stock units and employee stock purchase plans that we will talk about. I will mention performance shares, but we will not talk about it too much as of today. So let's review the tax implication of these various awards. And I would want to start with restricted stock units. Restricted stock units usually vest over 3 years, and at vesting, they are ordinary income. They you owe ordinary income tax, including Social Security and Medicare taxes. Let's review non-qualified stock options and incentive stock options. So non-qualified stock options at grant, there is no tax event. There is no holding period required. And at exercise, you pay ordinary income on the difference between the grant price and the exercise price. That's the spread. So again, if you decide to sell the stock, obviously that's one option. If you decide to hold the stock after that and you hold it for more than a year, then there is a potential for capital gain or loss above the basis that you will pay in taxes. Incentive stock options that we will talk a lot about again today, as I mentioned, no tax at grant. There is a holding period. You have to hold it for a year after grant. At exercise, you pay no regular taxes. So everyone tends to forget this, but no regular tax, but the spread, which is the difference between the exercise price and the grant price, so the stock price at time of exercise and the grant price. The bargain element spread is basically a preference item for AMT tax purposes. And this is why this is so important, that the exemption amount increased so significantly, as well as the income phase out for this, because more and more people will be able to exercise ISOs without incurring the AMT tax liability. So you do want to hold those incentive stock options based on the holding period, 1 year from exercise date and 2 years from grant date. If you do that, then there is going to be capital gain taxes in excess of the basis that you will have to pay taxes on. And there is many times folks decide to do what we call a disqualifying disposition. So for example, one of them is, and most of the time it happens, is that you don't hold ISOs based on, you don't keep the holding periods. And in many cases that might be beneficial as well. We'll touch base on that a little bit. And as I mentioned, performance shares, which we're not necessarily go into too details today, but I see them more and more. Companies use these performance shares. These are part of your equity compensation package. These grants usually are not granted upfront, but rather part of a long-term incentive plan. And a performance share is basically a form of stock compensation that is tied to an event in the future, such as meeting a target goal or overall performance of the company. So there I see a great variety of how these performance shares are structured, and it will depend on the company, obviously, you work for. You get paid in shares based on targets that are set for the company. So these grants can be performance stock awards or performance stock units, and each unit has a value added, and at vest it gets paid in stock or cash or combination of the both. And again, these are usually target-based, based on company for performance in the future. And performance share can be more beneficial than regular restricted stock, as can offer actually higher than 100% target pay in case of overachievement. So that's actually, I believe, the most is becoming also that what gives to its popularity a lot. So with that said, very briefly, let's review incentive stock options, or that's definitely, this is a major question at the end of the year as well, and at the beginning of the year, as I will mention. Incentive stock options are distinct from non-qualified stock options under the tax law because of the special tax treatment. So there are grant requirements. These ISOs can be granted only to company employees who receive W-2, and they cannot be granted to non-employees or contractors. I do have many clients by now who decide to become consultants rather in the field, and ISOs cannot be granted to them, only non-qualified stock options. There is also a $100,000 limit that can be, this is probably the trickiest ISO requirement, that under the IRC rules, the future market value of the ISO, which may be first exercisable in any calendar year, cannot exceed 100,000. So ISOs over this threshold at the time of the grant automatically becomes non-qualified stock options for tax purposes. It is usually employers understand this and know this and act accordingly. We talked about the holding period, obviously, of the ISOs, and also the tax treatment at ISO exercise. as well as we talked about, if you hold the shares, depending on how you taxed, whether ordinary income or you will be eligible for long-term capital gain taxes, that all depend on how long you're holding the shares. And again, the alternative minimum tax is always a crucial topic for anyone who plans exercise of ISOs and hold the shares beyond the calendar year of exercise. The Tax Cuts and Jobs Act raised the AMT income exemption, as I mentioned, and also the income point where this exemption starts to phase out. So this has reduced the likelihood of triggering the AMT. However, predicting the AMT implication of an ISO exercise hold remains a necessary part of your tax planning. The AMT system is complicated. I consult tax accountant in every single case. They are the ones who are able to tell you at the end of the day whether the recommendations by the financial advisor, how it's going to affect your taxes. So basically to your regular taxable income, it makes certain negative and positive adjustments. That's what the AMT does, and applies tax items called AMT preferences. And the resulting amount is your alternative minimum taxable income, which is much greater than your taxable income under the regular tax. So this is something that you want to keep in mind. So let's take a look at also restricted stock plans, RSU, and restricted stock differences. We will talk a lot about stock options, so I wanted to take a point of reviewing restricted stocks and RSUs. These grants don't give you the same potentially wealth building upside as stock options, but they have definitely a lot of benefits that I see clients really appreciate. In grants of restricted stocks, shares are issued upfront at grant, but you do not own them outright until the restrictions lapse at vesting, and thus you cannot, you really cannot sell or transfer the shares until then. And standard restricted stock units are similar, except that shares are not issued into your actual possession until the vesting occurs. And on the both restricted stock and RSUs, vesting usually happens after a specified length of employment. And I like to point this out. I really would like to talk about the Section 83B election. I see it very rarely happen. Really, it only can happen with restricted stock. So you always want to make sure that you understand what is that you are granted. Really, what happens is that if a valid 83B election is made within 30 days from the date of grant, when you are granted a restricted stock, and it's important to talk about it at the end of the year, as I see these grants a lot, obviously, at the beginning of the year, end of January and February. So you receive a restricted stock grant, you will recognize, and you have 30 days from the date of the grant when you can recognize that you rather pay ordinary income taxes based on the value of the stock at grant instead of recognizing the income at vesting. And as a result, any appreciation in the stock price above the grant date value is taxed at capital gain rates when you sell the stock after vesting. Obviously, this seems is like a huge advantage, but there are definitely disadvantages and risks that should, let's assume the stock never vests and you forfeit it because of job loss or other reasons, you absolutely cannot recover the taxes you paid on the forfeited stock. So for this reason and earlier payment date of required taxes on the grant date value, you usually do better by not making the election. And obviously there are also exceptions for this, but I very rarely see clients deciding to do a Section 83B election, and you also don't see too many restricted stock, but I thought it's important to point out. I also want to talk about ESPP plans, employee stock purchase plans. This has been for many years very popular in the technology sector. As technology sector more or less is entering the biopharma sector, I see it now at many companies as well. It is basically your ability to purchase a company stock at a discount from the current market price. And the biggest discount that the IRS allows is 15%, but it can be much greater if your ESPP has what we call a look-back feature. So basically your purchase price is 15% of the market price at either the beginning or the end of the purchase period, whichever is lower. And a typical planned purchase period, as many of you probably know, runs for 6 months. It also is tax deferred. It also has a holding period as incentive stock options. So for the money deducted from your paycheck will be taxed like the rest of your salary post-tax. You have the potential tax benefit under Section 423, what you can see there, that if you are willing to hold the shares for at least 1 year from the purchase date and 2 years from the beginning of the purchase period, any tax liability is deferred until the stock is sold, and only the purchase price discount, that original 15%, or your actual gain on sale, if lower, of course, will be taxed at ordinary income tax rate. So with the rest of your gain, as long-term capital gain, of course. And I always like to mention that you can dollar cost average into the ESPP plan, which is a very important financial tool to increase wealth. So let's talk about year-end action items, and that list seems very long, but it's actually very simple. And whoever emails me or sends me a note in the chat, I'm very happy to send how to think about this and how to put together a spreadsheet for this list, for what I call year-end action items. And usually, if you work with an advisor, you should have this in place, and you just need to update this list annually. But before we go into that, what I recommend is that you, as I mentioned to you, there's so much technicality in this, and you don't need to remember a lot of this. You need to remember some ideas, and your tax accountant will be able to help you and your financial advisor. But before we go into this, I recommend that you continue focus on traditional tax planning and asset diversification concepts, as well as financial planning. So what you need to look at here, you want to take an inventory of all your current holdings, your stock options, RSU, the restricted stock. Also, the stock in the company is very important for diversification purposes. You want to make sure that you are not, you don't have your eggs, as we say, in all your eggs in one basket, right? So you want to be diversified. You also want to understand what vestings happened in 2019 as it comes to your restricted stock units. Did you exercise options, ESPP purchases? You want to gather all of that. Very important for year-end tax planning. You want to understand what's going to be your vesting schedule for 2020. Again, with RSUs, you can predict certain income based on the current stock price. At least you can predict, you can estimate. You want to understand expiration dates for exercises. You need to understand what is that you should be exercising. Obviously, time to expiration is not the only reason why you exercise the stock options, but you need to understand that so you don't run out of time and you can plan ahead. You want to see if you can expect, many of you receive long-term incentive plans, so you need to understand what and probably take a note, plan ahead what you will be probably receiving in 2020. You need to understand blackout periods, potential. You will need to create a trading plan for next year. And in general, you want to understand guidelines, holding requirements. Your summary plan description for all these equity compensations plans should be able to tell you all of that. And I like to take a step back and really talk about and see why you are doing this. And this is probably, this is my only ability to put in a slide that has no taxes on it. But I also really mean this seriously, and I believe in this. So, you know, some say that money is neutral. It's neither good or bad. And it's basically a representation of your life energy in one way or another. But what I believe is what's important for us is our personal values. I do these exercises with clients all the time when I start working with them, and every few years, and our own values that pretty much have intrinsic worth to us. These are the qualities that we hold dear and in life. And I would say that you don't want to go through life reacting to it, but really proactively living it with purpose. And once you know and really think about in depth what is that for you, any other financial planning decision will be much easier. And I literally could say that at the end of every single slide, which I'm going to say right now, is that taxation is not a reason why you hold a stock option, when why you exercise the stock options, or you really need to look at how it fits into your current needs that will be in most alignment with your own personal goals and values, and what is it that you need to need the money for in this case. And you want to make sure that your financial goals are always in alignment with your personal values. And in that case, even a decision that potentially is a financial decision that you don't believe was a smart one will be easier to take, pretty much. So rather than letting your equity compensation drive your financial circumstances, I would recommend that you turn that around and first define your life goals, such as educating your children, achieving desired lifestyle, or retiring within a particular time frame, and then really let those goals drive your stock option or restricted stock decisions. So with that being said, you still want to make sure that you make tax smart decisions. I always advise working with a tax professional, and if it's possible, you want to create a multi-year tax projection using your best estimate of what you can do in 2019, 20, and 21. And obviously, you also always need to understand that how the volatility of the stock can alter the plan. I see that all the time annually, and that is definitely something that you want to think about. So year-end planning, here are some ideas that I'm going to start talking about. And year-end planning for company stock and stock options should focus on both the big picture and the details, right? So the big picture items can include a review of your goals, objectives, and financial plan. A year is a long time for a stock price, and fluctuations in your company's stock price may have made a material impact on the direction of your financial plan. And if you haven't taken the time to update your plan, year end is a good reminder. You do it year end, beginning of the year. And even if you've been updating your plan, year end is also a good time to strategize for the following calendar year, obviously. More specific year end decisions may involve detailed tax planning, obviously, and we are talking about here about important tax breakpoints. For example, as I mentioned, the AMT tax exemption amount, you should consider exercising the incentive stock options up to the alternative minimum tax crossover point. Again, the accountant will know what that means. The point where actually you can exercise ISOs and pay no AMT. You can also consider selling shares from previously exercised ISOs to the point where your adjusted gross income hits a higher capital gain tax rate, the threshold where AGI actually reaches the Medicare surcharge tax, or the point where you can reach the AMT phase out, and that can be beneficial for you as well. Other specific year-end planning may include that you sell ISO shares in an intentionally disqualifying disposition should the stock price have dropped during the calendar year. This may protect you from paying more in AMT than what the stock is actually worth. So that's definitely an idea to think about. Finally, your planning can also include an analysis to test the benefit of exercising non-qualified stock options or selling shares from restricted stock, RSU, vesting, or even ESPP purchase, any of which can increase your adjusted gross income. And a higher adjusted gross income may create additional room to exercise ISOs with no AMT. Taxes and exercise and sell may also create cash that can be used for you to pay for any financial goals. So those are all that you should be thinking about. And this is interesting. Employees, you can have planning ideas for the new year. So this is when implementation happens in the new year after January 1st. And I am not sure if you see the screen. I will stop here for 2 seconds, but I'm hoping you are seeing the right screen. I believe you are. So employees should be exercising their ISOs at the very beginning of the year, giving them a full year to make a sell decision that would have no AMT impact. And this is something that I talked about previously, and this is definitely interesting that incentive stock options, as we've been talking about it, have a lot of tax advantages, and there's a time that you want to disqualify them. So The ISO stock holding period begins on the day when the options are exercised. If you, as the employee, holds the stock more than 12 months from the exercise date, and obviously 24 months from the grant date, and recognizes a gain upon the sale of these shares, the full gain is considered long-term. If the stock is held less than 12 months, part of the gain is considered compensation and is taxed as ordinary income. So ISO stockholders, in this case, have an incentive to hold shares at least 12 months. But there is obviously a dilemma that we talk about a lot, that should ISO shareholders actually hold the stock and hope for more gains, or should they sell immediately after exercise? I get these questions actually a lot myself. The cost of being wrong, in a sense, can be dramatic. There are some folks that just don't have, obviously, faith in their companies. So if an employee decides to hold the shares, there is the alternative minimum tax trap, obviously, to consider. So you always need to make sure what happened there. And in calculating the AMT, the difference between the purchase price again and the market price is considered income. Importantly, the income is not AMT income if the shares are sold in the same calendar year, right, as the options exercise. This is many times confused with the 12-month period necessary to qualify for long-term gain rate. So you have to be careful that you understand that. And again, your tax accountant needs to understand it. So unfortunately, many employees actually have seen the price of their ISO stock drop during the year after exercise as they waited for their shares to go long-term. And without AMT liability, an ISO stock decline can damage your economically, I would say, but not in terms of taxes. So in fact, if the shares are sold below the exercise price, the employee could always possibly realize a capital loss. But if the ISO exercise has triggered an AMT liability, the employee could owe significant taxes on worthless stock, basically. So because of this, I would say employees should exercise their ISOs at the very beginning of the year. In certain cases, there are times there you need to do it at the end of the year, beginning of the year, both. Giving them a full year basically to make a sell decision that would have no AMT impact. So if the stock falls, they should sell before December 31, which would trigger a short-term gain or loss, but eliminate the AMT liability. At year end, if the stock has risen, they could hold for a few more days into January for the 12-month holding period to be achieved and then sell for a long-term gain. So this approach obviously can trigger the AMT, but again, the economic gain should probably outweigh the tax liability. So this is something definitely to consider. And I have to mention, as we talk so much about transitioning in the biopharma tech industries, and I help so many folks when they are negotiating new deals, that I definitely wanted to make sure that you also understand that you need to want to review pretty much your employee stock, pretty much everything, if you are contemplating a transition in the new year. And that actually doesn't necessarily mean that you are changing jobs. It can mean that you are retiring as well. So for stock options, the impact could range from forfeiture of all vested and unvested grants upon separation to retention of all grants to the original expiration date. The policy will vary from pretty much employer to employer, and your latitude to negotiate may be limited, of course, but you should at least understand the rules so that your financial planning can be adjusted accordingly. And one of the facts that I didn't mention is merger and acquisition. I literally just heard news from client yesterday that it will happen to her company very early next year, and there's pretty much limited tax planning that we can do based on the deal. So you need to be prepared for that as well. And for restricted stock or units performance share arrangement, again, the impact can range from forfeiture of unvested grants to continued vesting per the original schedule. So again, many things can happen. Review your stock option exercise strategy. If you hold in the money stock options that are scheduled to expire in the near future, for example, by the end of this year or next, or if you anticipate terminating your employment, obviously, as mentioned already next year, then you want to review that and figure out when to exercise them, potentially even till the end of this year, split them up in 2 years. For non-qualified stock options, the manner of exercise matters, and you want to review that. You want to review tax withholding, obviously. I recommend that you review your employer's stock award notices, you understand your stock plan administrator way of doing business, very important, because if you are in time of transition, that will definitely help you being ahead. And obviously, one other thing is that if this is not a retirement, but you are changing employers, definitely investigate and understand, or during negotiation, consider, for example, postponing bonuses to offset if you have to suddenly exercise a lot of options next year with the company that you leave behind. Make sure that you add that into your new negotiation plan with the new firm and try to defer as many compensation as possible for the year after. So those are the ideas around transition. And just a few more ideas. Literally is the last slide for today, that you can also do based on and this is really, I picked these final ideas based on the questions that I receive from clients. You can donate appreciated stock to charity. So if an option exercise, the vesting of your restricted stock or an ESPP purchase gave you securities that now have a low tax basis, I would recommend that you consider making your charitable donations using those securities rather than gifting cash. And again, this depends on your own personal financial situation and the priorities of your financial goals. When you donate appreciated stock, you have held for over 1 year from the date of option exercise or restricted stock vesting, you get basically a charitable deduction for the full market value at the time of your donation. So by gifting the securities directly to a charity or through a foundation or donor advised fund, you also avoid the capital gain tax that would otherwise be due on the sale of the security. So that can be a good idea. And under the Tax Cuts and Jobs Act, the standard deduction in 2019 is $24,400 for joint filers and $12,500 for single filers. And 1 year end strategy can be also to bunch donations together in a year that puts you over these amounts, so that by itemizing you get a larger total deduction. You might not be able to itemize every year. So you could perhaps make 2 or more years worth of donations in 1 year to itemize, then reduce donations in the next year to take the standard deductions. So you could do this with company stock donations using a donor advised fund for the charitable deduction if you are not ready to select all of the recipients of your donations. And also be careful not to donate stock that you received on the exercise of an ISO or the purchase of an ESPP shares until the disqualifying disposition period had passed, of course, if that's what makes sense for you. Again, we talked about that both can vary depending on your situation. So you can also make gifts of stock. You can consider making an annual exclusion, gifts of stock, before the end of the year. In 2019, you can make an annual gift of $15,000, $30,000 if you do it as a couple, to any number of recipients without incurring gift tax or using any portion of your lifetime gift tax exemption. Obviously don't make a gift that subjects you to gift tax without first speaking to your tax advisor, as I have to mention. And you may make annual gifts up to specified limits without tax implications. So you want to discuss that with your advisor, tax accountant. And gifting low basis securities that you intend to sell has traditionally been an effective way to reduce overall family income tax, obviously, but be aware of the kiddie tax, which is pretty high. And as discussed, the lower capital gain tax rate for long-term holdings may provide an even greater income tax incentive for making such a gift for you. So that's one thing to consider. And the last two is exercising options for depressed shares. And can they be ever good to exercise? Again, I see this, and we have to make these decisions at all times sometimes because of just expiration of options, but you might do this intentionally as well. So there may be a silver lining here. So when you exercise non-qualified stock options, you have to pay ordinary income tax on the difference between the fair market value of the shares at exercise and the exercise price. Again, when you exercise ISOs, even though you are not subject to ordinary income tax, you may trigger the AMT. So the future market value of the stock minus your exercise price is the amount that affects the calculation of the AMT. And exercising options when the fair market value of the shares is relatively low can actually minimize tax obligations in both scenarios, particularly with ISOs. So in this case, in the case of non-qualified stock options, this exercise also starts the time frame for future gains to be taxed at a lower capital gain tax rate. So I wouldn't consider this approach if the shares have fallen so far that your options are out of the money. First of all, you can do it, or you just have better alternatives for your money. And also, this strategy works best if you also intend to hold the shares and your options will expire relatively soon, as I mentioned before. And again, it should be always investments and not tax consideration that drive your decision. And remember the additional Medicare tax is the last suggestion here. So if your income will trigger the surtax next year, potentially, but not this year, 250,000 next year, potentially lower this year, and you have company stock you intend to sell soon, you may want to consider selling in 2019 rather than 2020 to avoid the additional 3.8% tax. So for example, a person who has incentive stock options holds ISO stock and plans to sell the shares after 1 year may want to evaluate the impact of the current top capital gains rate, and along with the Medicare tax on investment income, lower taxes may result from selling the shares in 2019. So just to further explain a little bit, the 3.8% surtax doesn't apply to income from stock option exercises or vesting of restricted stock unit. It applies only to the gains from selling shares that have been held, right? And however, income from the exercise purchase will increase your adjusted gross income. You also may want to protect your income from equity awards to see whether it will trigger the Medicare surtax on investments income and the 0.9% additional Medicare tax on compensation income. So depending on your projections, exercising in 2019 that you plan to exercise in the next few years, you may avoid both higher potential ordinary income tax rates and these Medicare taxes. So that's definitely something to discuss with your tax accountant as well. And let's look at our key takeaways. And I would always start by clarifying your financial goals, right? So all of your goals and want to make sure that your financial goals are aligned with your personal values, and understand the various equity grants that you have and make sure that you are continuously updating the list, the checklist that we mentioned, the vesting schedules, grant dates, exercise, what you exercised in the past year, what you will exercise in the next year. Keep important checklist of these dates. Make sure that you update these twice a year. And also work with a tax professional and a financial advisor and monitor all aspects of your tax planning at all times. So with that said, I really appreciate your patience today. As you can see on the screen, feel free to reach out to me or to us at Freedom Trail Financial. His email is bdragovic@freedomtrailfinancial.com, or feel free to call us. We will send you the recording of this webinar in the next few days. And thank you so much for listening today, and wish you all a happy, healthy holiday season, as well as Happy New Year. And we will be in touch soon with the recording, and make sure that you have answer any questions that you have. Feel free to email us anytime. Have a great day.